Hi everybody and welcome to Erik Penser Bank. My name is Jonas Thulin, I'm head of asset management here, and I will briefly, as a tip of the iceberg, give you an insight to what we think about the world right now, which is quite interesting given the quite rapid price move we saw after the CPI number last Friday. And first point we want to make is that we are overweight equities, but depending on how your portfolio is constructed, you can either carry that overweight or you're having problems carrying that overweight. If we compare to our performance, if we had a neutral asset allocation compared to an overweight asset allocation, we're actually making more money on being overweight than neutral. That might seem a bit odd, but do remember that this is the first year since 1997 that has both falling values in rates and equities. I.e., depending on how you treat your equity investments, in what currency you decide to do the investments, sterling, yen, perhaps not yen given what's happening in the market, Swiss franc or euro dollar, you can actually, through that exposure, keep your investments for a bit longer than would otherwise be possible. So 2022 is so far a unique year, and it's the first year since 1997 that we've seen this tremendous fall off in both value terms of on equities and rates. As you have on the top right and bottom left, with the courtesy of macro bond, you see the performance on equities versus corporate bonds, which is even worse than yields, of course. So it's quite unique. So how are we treated and how are we thinking? Because we're still working and striving to beat our global benchmark, which we are doing so far this year. But for us, as we described last week or a couple of weeks ago, it's a lot about paradigms, what's actually running the markets right now, how can we derive what's happening on the equity market. And if you look at these paradigms, it's the same graph as I showed you a couple of weeks ago, but something has happened. And it's actually on the bottom line here, we can see the financial conditions starting to pick up again, which is a bit nasty because that depends on the rates and the squeeze they've seen in the market. And you can see the US macro is not delivering the positive momentum anymore. That means if we highlight these two, you can clearly see the potential or the risk, if you like it, of a changed paradigm, i.e. we're going to fall back to rates being the pivotal driver, not US macro, i.e. a more negative scenario. When we saw this opening up, what we did is that we quite rapidly moved into the data and tried to find out what's actually driving financial conditions. Well, you have the currency, which is a great hedge for us, so keep that open as much as possible. We do not utilize VIX anymore. It's a little bit of a dead fish in the water for the time being. However, rates has made a great move. So given this, we then put it into our calculations. So what equity markets are most exposed and most depending on US rates. And if I flip through a few pages, you can see here that you have the beta versus US interest rate changes, and it's the highest on European equity markets. I.e., if we're afraid of US rates and we want to hedge that a bit or take advantage of it, look towards European equity markets and perhaps European banks. That was our pick. We are still keeping that position. We put it on last week in anticipation of this yield move higher. And as I mentioned before, we want to anticipate and take advantage of that yield move higher because we think that is the driver of the equity market. One reason why we should also keep in our back of our minds is that geopolitics is no longer a driver of the market. So you can see here that we're actually touching the historical average we've seen since 1945. I.e. we are as geopolitical stressed now as we normally are in the post-Second World War. Again, equity markets are perhaps a bit naive or blindsided or careless in terms of the human tragedy. But it is what it is in that sense, and we keep on monitoring this. If it's going to come back as a main driver, we will take notice. But so far we're back to financial conditions and CPI. CPI for us did peak in March if you look at what's priced in break-evens. As you can see, it moved up. As I mentioned before, you had the financial conditions, you had the yield move, i.e. we went into Europe and looked at banks. So we tried to take care of that little move up in break-evens. But it's not so far, or not yet I should say, enough to make us to do any larger changes or larger just strategic allocation decisions. And the reason is that we see that the price pressure from Asia is actually, or China is actually coming down. We see the commodities are talking for a lower CPI. We see that 5-year swaptions is talking for a lower CPI. We can look at US supply pressure. It's also coming lower. Supply disruptions is coming down. And so you can actually see core CPI actually did peak and is maintaining that peak. And you can look at global supply chain pressure, which is also falling off a cliff here, which is positive in this sense. So there's quite a lot of moves that we see that are positive for inflation. The port activities is extraordinarily effective right now, and there are no supply bottlenecks here to speak of. So that means that the one-year inflation outlook from the US consumer, which you can see versus the blue since the early 2000s, is actually a good front-running indicator of this, has fallen from 8.5% to 4.5%. So again, speaking of a clear peak. Now, that is what it is in terms of core CPI, in terms of break-evens and supply bottlenecks and everything. But the headline was still a bit of a worry, as you can see in the cash markets. And we recognize that, and that's why we did the trade in European banks ahead of the number. But also do note that the two sectors that pushed up the inflation number was transport, i.e. fuel and food. Not any other sectors actually with a lot lower inflation. That means the core rolled over, but you can also take these individual parts and translate them into a PCE number, which is obviously the Fed's preferred CPI number. And if you do that exercise, you can actually see that PCE has rolled over. Now, in the sense of the market, rolling over means 0.2 or less month-on-month increases. That is enough to sort of push down the overall headline inflation, which is quite interesting. So the Friday number was both a confirmation of the peak, but not a peak, as we can see on the headline number. And depending on how you treated the headline number, you can actually see that you're not above the March high, or you were slightly above it, all depending on which headline CPI number you actually calculate your annual numbers on, and how you do your annualized numbers. So it's a little bit of a touch and go. Then again, the cash market reacted the way it did. We tried to anticipate that through the European bank investments, but predominantly we're keeping the dollar exposure. We're still short S&P 500. That obviously leads us to afford, in that sense, to keep our overweight on the equity market, which is something that we still carry with us. This week, we're going to have a strong retail sales numbers in the US. We're going to have a good industrial production numbers. You're going to have an extraordinary, fascinating Fed. We think the Fed will come out and talk a bit more hawkish than they actually would prefer to, because they realize now they have the CPI number that they can act on. They don't want to talk hawkish during the autumn because we have a midterm elections. They want to be politicized again, as you can argue that Trump tried to put them down to. That means if they talk tough now, they might not have to deliver as much. Now, given the CPI, there were enough clues in the CPI numbers to anticipate the rollover. They have this chance and this chance alone, and we think they will deliver a bit more hawkish than they would otherwise, in order not to being forced to deliver more further down the line. So we're keeping the positions as they are today, and we're going to track and cover the Fed meeting live, and we'll see if we're going to do something more. But we think we have enough protections and an evenly distributed portfolio, especially given our exposures in commodities and alternative strategies, to keep our equities on the table. Because further down the line, we can already see the end of the hiking cycle as confirmed by the rate market, and we do not see a recession in the US. We still have 15% probability. The equity market is priced in about 80. So the last thing we want to do is to get rid of risk right before we see the light at the end of the tunnel, because we know the first couple of days you're never going to get them back, and they're mostly the most positive ones we're going to have. And as we all know from theory and historical backgrounds, to avoid the worst downside days is not nearly as effective for a portfolio as being able to capture the rebound days. In order to capture rebound days, you have to stick with risk on the table. We try to meddle around and adopt risk as much as possible, i.e. given what we've done the last couple of weeks, or especially last week with the bank. But that said, clear, and right now what we've done is actually we dropped off, or we took off our VIX coverage, keeping dollar obviously and short, and the rest of the risk on the table going forward to the Fed meeting. And hopefully we're going to see a summer and autumn of sustained economic power and growth where we are invested. And also that we're going to see, yes, the Fed will hike rates, but it's already priced. So the effect on the market will be less and less as we move forward. And that should be positive for the equity market for the second half of this year. We will be back in August, September with the next video. If something extraordinary happens, we'll be back ahead of that. But if not sooner, we wish you all a very happy and pleasant summer, and we'll be back in August and September. Thank you so much.